Coming up on today's show, bond yields and stocks fall lower, more signs the jobs market is softening, Wall Street banks predictions for next year, oil falls below $70 a barrel, Wall Street's most important man wants the government to shut down crypto, and a look at my indicators that say a reversal could be about to happen. Good evening, guys, and welcome back to the Click Capital Daily Market Show. Thank you very much for tuning in. My name's Jared. I'm going to get you all up to date on everything that's happening across financial markets so we can all make better financial decisions. And I do these shows every day, Tuesday through Friday after market close, so hit that subscribe button if you haven't already, and I'll keep you up to date. And so overall, it was pretty bearish out there today, especially in the tech space with the Mega Cap 7, the losing group today. However, breadth was a bit checkered. We did see a bit of strength in the defensive sector utilities and a bunch of industrials perking up as well. However, we had a big fall in oil again, which sent oil and gas stocks down. And we also saw a bit of weakness in the financials. And what got markets moving today was some economic data showing more softening in the jobs market, with wage growth hitting the lowest level since 2001. And for the month of November, private employers added 103,000 jobs. And that's quite a bit below the 120,000 projected by economists. And so this is a sign the market and the Fed has been looking for. They want to see a cooling jobs market, and that's going to help keep inflation coming down, in addition to the falls in the price of oil. And so as expected, we saw some falls across the Treasury yield curve, especially in the long end. And this could be a bit of a preview for what we're getting on Friday with non-farm payrolls and the unemployment rate. And for the last couple of months, the stock market, bonds, gold, and Bitcoin has been liking that softer data coming through, as the market's pretty much pricing a 97% chance that the Fed is done hiking rates. We're even starting to get a little bit of probability they might start cutting as soon as next month in January, with the market given about a 60% chance they will have cut come March. And so as you'd expect, government bond yields have been falling on that data and expectation, and that deepened further today. Even got the 10-year now at 4.10%. It was only just over a month ago we briefly got above 5%, so that's 90 basis point move in about 5 weeks, which is a pretty swift repricing and quite a bit of volatility for the bond market. And that's helped put TLT in what looks like we can safely say is a confirmed bottom here, around the low 80s. And since yields have pulled back, the bond market has bottomed and bounced up quite good here. However, we got some interesting candlestick patterns on the charts today, especially in the S&P 500. We gapped up above yesterday's high and ended up finishing on lows below yesterday's low, and that's what's known as a bearish engulfing pattern. And the last time we got that was back on the 27th of July, and that marked the top in the S&P 500 for the next couple of months. And we ended up falling almost 600 points down to late October, where we found a quick bottom before we've had this 500 point rip up, basically in a straight line since then. However, stick with me because I'm going to come back to the charts later and show you all my technical analysis, as why I think the stock market could be about to do a pullback here, and where we could expect that pullback to stall out, and some other key levels to watch for. So the other thing that should have helped stocks today, however, it may be starting to get investors worried about global economic growth, is the sharp falls we've been seeing in the oil price, breaking through key support today and settling at the lowest level since June on concerns of oversupply, which has been the trend for a bit over a month now. Not even more of a drop in crude inventories reported today in the US could help the price of oil from falling. However, we saw a big increase in gasoline stockpiles, rising by more than 5 million barrels last week versus estimates of 1.3 million. We also got economic numbers from China showing a further slowdown, and as Asian refinery run rates continue to drop, with Saudi cutting cash crude prices for next month to China. And the market might be also looking at the US jobs market, which is softening and kind of forecasting further weakening of demand. And even though OPEC Plus have been trying to stem that fall by finally agreeing to additional output curbs of 1 million barrels per day, along with Russia hinting at further production cuts, that hasn't been enough to put a floor in oil prices just yet, as the United States, the world's largest oil producer, continues pumping it out at record levels. And there's strong political and business will to keep deleveraging from the Middle East and becoming more and more self-reliant on energy. And we can see that in the daily chart of crude oil futures, falling a huge 4% today on above average volume, cutting clean through the $70 level barrel. And like I said, I expect it to come down and test this support from mid-year around $67 a barrel. That's around the bottom of my buy-sell band indicator as well. So if we were to get there in the next day or two, that would be quite technically oversold and might be setting up a good risk-reward for a bit of a bounce play. Mean reversion back up to the 50-day VWAP. As I can see, we're already 12.7% below the VWAP. which is nearing yearly extremes at minus 15%. So we're getting a little stretched here, but this doesn't bode well for upcoming economic growth. There's natty gas falling as well, and copper doing a big reversal these last couple of days. And we can see that in the copper gold spread as well, turning back down underneath a 50-day VWAP. So it looks like the market is forecasting weaker global economic growth, and it could be a case of the States finally catching up to the rest of the world instead of the rest of the world catching up to the States, which has been the outlier in economic performance this year. And so fall in oil, inflation expectations, and interest rates has caused a bit of an everything rally this past month or so in stocks, bonds, gold, and crypto. Bitcoin recently just passing that big $40,000 a coin level. It's now starting to get back into the headlines, mainstream media, and likely a lot of retail traders coming back into the space, and has also attracted the attention once again of Wall Street's most important man and number one public enemy of cryptocurrency. It's JP Morgan's CEO Jamie Dimon speaking in a Senate hearing today. Said, "I've always been deeply opposed to crypto Bitcoin. If I was the government, I'd close it down," saying crypto companies should be required to abide by the same anti-money laundering rules as banks, and points to the currency's use for illegal activities like terrorism, drug trafficking, and ransomware attacks. And we haven't really got any clarity out of Washington on how they're gonna regulate or approach crypto. It's been going on for a few years now. We know SEC's Gary Gensler wants to shut it down. The industry's been fighting back. We've got applications from Fidelity and BlackRock to start spot Bitcoin ETFs, and being the largest asset managers in the world, you'd think they wouldn't make that bet unless they were pretty sure that it was going to go through. So I'd say as it stands now, those spot Bitcoin ETFs should go through and open up the floodgates to institutional money. And as long as big business, Wall Street, and the government can profit from it, regulate it, and control it, it should be here to stay. And just like Jamie Dimon says, they should just have to play by the same rules as the big banks. And whilst he's right, a lot of it's used for illegal activity. I think overall it's good because it helps to keep traditional finance honest and on their toes, and provides some good competition to help push financial innovation forward. And just look at that rip up in the price of Bitcoin. Just a beautiful technical move of volatility and volume expansion, and then coiling back up into another expansion. And we might be a little stretched here in the short term and due for a pullback now that everyone's talking about it. However, I would expect this previous resistance to turn into support once again, just like it did at the $35,000 level. And until those spot Bitcoin ETFs come on the market, it should find support and buy the dips. And just taking you out to a weekly chart on Bitcoin, prior to the last peak in late 2021, at the height of the everything bubble, when people were paying $1 million for a picture of a rock, the previous bubble in Bitcoin was in late 2017. And there was rumor and speculation back here that the Chicago Mercantile Exchange, CME, was going to list Bitcoin futures, which they actually did on this week here in the middle of December. And so the market ripped up from 3,600 a coin in September. Huge percentage gain, up over 400% in just a couple of months, where it peaked out just below $20,000 a coin, like markets often do around big psychological levels. And that marked the top for quite some time in crypto, the launch of Bitcoin futures back then. And prices ended up falling over the next couple of years, getting back down to low $3,000 before we found a bottom. So here we are today. It could be the same pattern going into the launch of spot Bitcoin ETFs. We still don't really have a time frame on when that's going to happen. Could potentially be in Q1 next year. And so I wouldn't be surprised if Bitcoin keeps ripping up over $50,000 a coin, with a bunch of small pullbacks along the way until we get that launch. And it could be another story of buy the rumor, sell the news. And just taking you out to a clean monthly chart on the total cryptocurrency market cap, we've just gone over 1.5 trillion, 1.56 as I speak, and that's still down almost 50% from its peak in late 2021 when it hit 3 trillion to the dot, then fell down to 700 billion late last year. And since then we've more than doubled, and it's been one of the best performing major asset classes this year. And that's still without a lot of retail flooding back into the space, so it could still have a lot of fuel to add to this fire. And when it comes to crypto, there's no telling how high and crazy you can get. And so make sure you stick with Click Capital, and I'll keep you updated on everything that's happening there. And just getting back into stocks, first we'll just look at what some of Wall Street's biggest banks are predicting for next year, with a pretty wide dispersion. Some predicting recessions, some predicting another roaring bull market, with most bearish being BCA Research, saying the S&P 500 could experience its worst crash since 2008 next year as a recession kicks off, saying developed markets around the world remain on a recessionary path unless monetary policy eases very significantly. They don't expect inflation to slow quickly enough for the Fed and the ECB to cut rates in time to prevent a significant rise in unemployment. Also bearish is JP Morgan, with an S&P 500 price target of 4,200, citing high equity valuations, high interest rates, a weakening consumer, rising geopolitical risks, and a potential recession give it little confidence that stocks will move higher in 2024. Neutral is Morgan Stanley with a price target of 4,500, along with Goldman Sachs at 4,700, and coming in the most bullish is Deutsche Bank with an S&P 500 price target of 5,100, saying if an economic recession does materialize next year, it shouldn't impact stock prices dramatically because most investors are anticipating it, expecting the S&P to rise about 10%, and if the economy does dodge a recession, the gains could nearly double to 19%. However, has the stock market already got a little ahead of itself in terms of expecting a Santa Claus rally and a good next year? We've gone from a condition in late October of very technically oversold and a lot of bearish sentiment to pretty much flipping it to the other extreme, getting a bit overbought here, and positioning is back to bullish along with a widespread consensus that stocks are set to continue rallying. And we can see that in the Fear and Greed Index, which is a little elevated here at 63. We also got the AAPL Investor Sentiment Survey with a bullish reading back to just under 50%. That was the same level where stocks last topped out in mid-late July. And active investment managers are back to bullish positioning with the NAM Exposure Index now showing 81, again near levels where the market put in short-term peaks. In addition to that, we just got a huge spike in corporate insider sales coming in yesterday, 333 versus only 71 purchases. Again, something we see around market peaks, as insiders do a pretty good job at selling the rip and buying the dip. And looking at my custom indicators, institutional buying percentage, still slightly in the neutral zone at 47%. Once it goes below 45, that'll be bearish, where it has been for the last couple of weeks, and a similar pattern to when we last saw a top in the market back in July here. Along with the S&P 500 oscillator, still technically overbought, but could be starting to set up a divergence like it did back in July, when prices rise and the indicator kind of stalls out and falls a bit. And just looking on my regular charts, now starting to show a divergence on the DSI, looking from that big gap up move on the 14th of November. We've ripped up over 100 points since then. However, the DSI has stalled out and now falling, and we've also got a bit of a divergence happening on my hidden divergence indicator, also in negative territory, and we seem to be stalling out at this resistance zone from that last bearish engulfing candle on the 27th of July, where we put in a high for the year at 46.07. We got within 8 points of that on Friday's session. However, the market's clearly coiling up. We're stalling out momentum, and then we've got a bunch of bearish engulfing candles and dark cloud cover candlestick formations on the charts today, like I'm about to show you. And stick with me to the end of this video, because I'll give you my projections on where I think the S&P 500 could pull back to, where it could stall out, and where may be a good buying the dip opportunity. First, let me just take you through all the rest of today's markets on the charts and get you updated on the technical picture out there. Still got low volatility and some sideways action in international stock markets, except for Germany's DAX. That's been on an absolute tear this last month. China's 50 continues to fall and looking to find a bottom, and Japan and Australia continue to trade a bit sideways. Slight uptick in the VIX today, but still not much. Still really low here, below 13. And option dealers looking for 3 points of premium in implied volatilities over current realized. Bit of an uptick in oil volatility, and that's continuing to remain quite elevated, along with bond market volatility as well. But short-term breadth starting to turn back down, still quite elevated here, and breadth still holding up pretty good as measured by new highs versus new lows. We do have some pockets of the market still showing some strength, like home builders and utilities liking these lower yields, and the airlines and cruise stocks liking the lower oil price. However, we've got some growth sectors like tech stocks versus the Russell 2000 now underneath its 50-day VWAP. And look at that fall in the spread of inflation expectations. Inflation protected treasuries versus regular treasuries. That's the price of oil really helping inflation expectations to come down. And even though the bond market, Fed Fund Futures, is forecasting a recession next year, investors are really pricing in a soft landing. We can see in the price action in high yield corporate bonds, with no fear or pricing that we're going to see a lot of defaults in the recession. Rather, the market is just expecting a soft correction. Another little bounce in the dollar back above 104, and there's oil just hovering above 2,000 an ounce in this big resistance zone, and we're yet to see how this big reversal candle is going to play out. I'll be looking for it to find support around 2,000 an ounce, maybe a little bit below. And if we were to get a close below 1950, I would say that could confirm that big reversal candle, and it indeed was a fake out. However, I'm still not sure just yet on this one. Also got uranium hovering in that big resistance zone near highs, and a big pullback today in agricultural commodities thanks to a huge fall in sugar, along with a pullback in orange juice. Over to stock sectors today, the winner was the cannabis ETF MSOS. Those of you who watch my channel know I'm in this sector for the long term, and like I said, back down here we're really deeply oversold, had a lot of technical signals saying that could be a bottom, and we've now ripped up over 50% since then, and this is trading like somebody knows something, because we don't have any real solid news coming out on the legislation front. However, looking at this price action, the market's thinking we're going to get something good, maybe with the DEA rescheduling it from Schedule 1 to 3, and maybe something good on the Safer Banking Act, or something else brewing in Washington possibly. Second winning sector today was global jets, the airlines, loving the lower oil price as their biggest cost variable, and the home builders as well with those lower rates. Coming in number 3, no surprise, the losing sector today was oil and gas, down 2.6% on the falling price of crude. Following it were energy stocks, and coming in third were IPO stocks, along with a good bounce in utilities. And we've got a bit of a turn down reversal off a resistance zone on the BlackRock barometer. Largest shipper in the world continues to trade weak, and we got a bearish engulfing candle on JP Morgan, along with a dark cloud cover formation on Apple and Microsoft, and a big reversal candle on NVDA after gapping up in the morning above 470. It tried to go for a run. However, it was met and overwhelmed by sellers who closed it on the lows at 455. We may lose this support zone and the 50-day VWAP. That's one of the most important stocks in the market. Same deal with Amazon stalling out at resistance. Tesla was the only mega cap to tick a little higher today. And some continued good moves up in the defense contractors, still holding on to their gains after the gap up from the Israel-Hamas war first kicked off on the 7th of October. Along with Israeli stocks as well, recovering all of their losses from the initial dip after that. There's Alibaba getting down to 71. I think this is good levels for a long-term buy, and looking a bit short-term oversold as well. Got a nice bounce up in Walgreens today. May have found support at $20 level. Now back above the 50 at $21.38, and a bit of mixed price action in the banks there to finish out today's trading. Okay, so my final thoughts on the S&P 500. Say we're getting odds now that we're going to get a bit of a pullback over the next couple of days. We could get a move off Friday's jobs data, and we're starting to get some bearish divergences on my indicators, along with those bullish sentiment readings. The market has finally chased price and positioned bullish. We seem to be rejecting off that prior bearish engulfing from the 27th of July at 46.07. Maybe the market doesn't peek its head above that, and we may just get a really quick, sharp, shallow pullback just down to 4,500. However, if 4,500 weren't able to hold, I'd say we'd trade back down towards 4,400, which will be around where the 50-day VWAP is, and a bit above where we turned back in mid-October around here. As we have had a 500-point rip, we now got option dealers increasing their implied volatilities a little bit, and we're getting some bearish candlestick patterns across the market. And we got the Magnificent 7 falling 1% today, and seeming to have already done a bit of a pullback, and so we still might have other sectors of the market hold up better, like we saw today with home builders, jets, and utilities on the back of those lower rates and oil prices. So maybe a case of big tech continuing to pull back and then pull back the S&P 500 with it. However, as usual, we'll play it day by day with every piece of new data we get in, and we'll do our best to see what we can make of it all. That's all I got for you today. Thanks very much for tuning in and hitting that like button, and I'll see all you guys again tomorrow night. Cheers.